When you check your financial news apps lately, the data points to a singular, overwhelming sense of panic. Record lows and market flight dominate the conversation, leaving most investors feeling entirely out of tactical control. That anxiety is a natural response to seeing your currency lose ground against the dollar week after week. It feels like an immediate, localized crisis. This chart shows the 10-year historical timeline of the rupee. Looking at this data, we see a measured, mathematical decline rather than a sudden or unexpected crash. The correlation becomes clear when we add the U.S. Federal Reserve's interest rates to the chart. The steepest drops in the rupee's value align precisely with the moments the U.S. decided to hike its own rates. When the U.S. increases the yield on its treasury bonds, it acts like a giant magnet for global capital. It pulls liquidity out of emerging markets like India and relocates it into American assets. In this context, the rupee isn't failing on its own merits. Instead, the US dollar is acting as a massive global vacuum, absorbing liquidity from every other currency on the planet. While Mumbai and Delhi manage local policy, the baseline value of your cash is engineered here, inside the US Federal Reserve. Because foreign central banks hold this much gravity over your money, simply leaving your cash in a savings account isn't a neutral move. You have to actively defend your purchasing power. This is the primary trap for the average saver. The nominal numbers in your bank account stay the same, but your ability to buy things on the global market is silently bleeding out. You feel this every time you pay for fuel, as India imports the vast majority of its oil in dollars. You see it in the price of imported electronics, where component costs are tied directly to exchange rates. If this imported inflation makes life more expensive, why doesn't the government just step in and artificially lock the rupee's value to protect its citizens? The Reserve Bank of India manages a different set of priorities, balancing domestic inflation against international trade. They recognize that a slightly weaker rupee gives Indian businesses a competitive edge. It makes Indian software, pharmaceuticals, and manufactured goods more attractive to foreign buyers. Keeping the currency at this level keeps the factories running and services shipping out, which secures millions of jobs and brings foreign revenue into the domestic economy. Since the RBI must prioritize national trade leverage over the cost of your next smartphone, the responsibility of hedging your own portfolio falls entirely to you. To build a wall against a surging dollar, you have to look past simple savings and evaluate where your capital is actually parked. This quadrant chart maps our options. We're measuring each asset by how much protection it offers against a rising dollar versus the market volatility you have to tolerate. Most households default to strategy A, keeping 100% of their wealth in domestic fixed deposits. FDs guarantee your local principal is safe. However, when you factor in taxes and currency depreciation, these accounts mathematically guarantee a loss in global purchasing power over a 10-year period. Consider strategy B instead, diverting a portion of that capital into sovereign gold bonds or digital gold. This allocation moves you up the chart. Gold carries more price volatility than a bank deposit, but it provides significantly higher protection against a falling rupee. Gold acts as a passive hedge. Because it is an international commodity priced in dollars, when the rupee falls, the domestic price of your gold holdings naturally rises to compensate. While gold is a perfect defensive shield for wealth preservation, it produces zero corporate earnings. It is a tool for holding ground, not for aggressive wealth creation. Strategy C is for those who want to weaponize the strong dollar by investing directly in U.S. equity markets via Indian mutual funds. This strategy targets global growth engines, specifically the massive technology firms that dominate the U.S. market. The core benefit here is the dual return, the ability to profit from two separate variables simultaneously. Your total return equals the U.S. stock market's growth plus the gain in the USD exchange rate. If your U.S. fund grows 10%, while the rupee drops 3%, your actual local return yields 13%. But capturing these dual returns requires you to accept the full, unpredictable volatility of a foreign market. Furthermore, India's complex tax structures on foreign equities, including capital gains and tax collected at source, will eat into these theoretical profits. U.S. equities are a powerful mathematical defense, but their volatility and tax friction make them a specialized tool rather than a universal solution. Choosing between these assets depends entirely on your specific capital timeline. This decision tree routes you to the correct strategy based on your impending financial liabilities. Profile A includes those with immediate international obligations, like students heading abroad in the next 1 to 3 years. If you are a global payer, you cannot afford currency fluctuations right before a tuition payment is due. You must prioritize liquid international funds or hold physical USD. Profile B represents the salaried professional building wealth over 5 years or more within India. You should stay invested in India's domestic growth, but allocate 10 to 20% of your portfolio to gold or US funds to act as a shock absorber against inflation. Finally, Profile C covers those near retirement who are focused on preservation. Since your expenses are entirely local, avoid aggressive US equity hedging. You cannot afford foreign market volatility when you no longer have the time to recover from a correction. You have no control over the US Fed or the RBI's currency interventions. The only variable you can control is your asset allocation. By anchoring your portfolio with intention, you can withstand the global macroeconomic currents. Never bet against the growth of your own economy, but always buy the calculated insurance necessary to protect your purchasing power.